Hello, everybody. Welcome to this panel on next generation DeFi liquidity models and the new DeFi phase. We are really excited to be joined today by Mark from Carbon DeFi and Bancor and Georgi from Blocksense. Um, would you guys be able to share a few words about yourselves while we are waiting for everybody to join?
Certainly. I'm happy to go first. My name is Mark Richardson. I'm the project lead at Bancor and Carbon DeFi. Carbon being the flagship project, the flagship product of Bancor. I've been with the project since 2021 in an official capacity, and before that, in an unofficial capacity, just as a anonymous community member. Prior to DeFi, I was a organic synthetic chemist. So during the pandemic, I was still a postdoctoral fellow at the Commonwealth Scientific and Industrial Research Organization in Australia. And prior to that, I had a fellowship at the University of California, Irvine. So yeah, I've made the transition from biological life and physical sciences into sort of finance, blockchain, and cryptographic security protocols during the pandemic.
Wow, this is a really exciting background. What about you, Georgi?
Yeah, cool. About me, I I have a mixed background as well, kind of between engineering and business. For a while, I was in the VFX industry. I developed a fluid dynamics simulator, also a renderer. It was used in like different movies, commercials, and stuff like that. Then after that, I got into the blockchain space, and I did this kind of again engineering for these privacy preserving protocols. We tried to build a Zcash type system that would support like many different assets, not just Zcash. And Zcash is blowing up now, but anyway, our product didn't really blow up that much, and we actually pivoted it into building a layer two, which did pretty well, uh, comparatively to all like other layer twos. And then at like 2023, during 2023, I kind of transitioned into this more of a business role, and I founded Blocksense by my partners. And with Blocksense, we're building decentralized oracles and kind of developer tooling for ZK and for compilers and like different like for AI and different like agentic coding and stuff like that. So yeah, that's a little bit about.
This is awesome, and we are definitely going to go into ZK at the end a little bit. But first, we are going to start by talking a bit about the state of DeFi at the moment in 2025 and see where we started back in 2020, somewhere around 2020, and where we moved to, and why we moved here, how we basically went through this whole transformation of different DeFi protocols and what triggered these transformations. And then we are going to talk about how traders shape the system, how different risks arbitrage nerve affect the way that DeFi protocols change their liquidity models. Then we are going to move into the oracles and the data layer and see what kind of role playing in this whole system. And then we also see about low latency ZK and about your projections for what you think the future holds. And we'll talk about future designs as well. But let me start by asking you, what do you think is the defining theme of DeFi in 2025 if we are comparing it to AMMs going mainstream in around 2020?
Sure, I'm happy to comment. So I think you know most people would attribute this going mainstream concept for AMMs and maybe DeFi more generally in 2020. I think because of the sudden onrush of incentives programs that were going live at that time, right? So it kind of it's hard to say exactly where it started, but certainly projects like Synthetics and Compound, I think are sort of competing neck and neck for sort of the accolade as being the people that really figured out how to onboard a huge number of users very quickly using their own token as an incentive to drive that kind of adoption. But of course, it quickly spread after that. We saw things like the vampire attack of SushiSwap against Uniswap, which may or may not have precipitated Uniswap's very own token just to win that liquidity back, and so on and so forth. And then eventually this kind of process spread to entire blockchains, really, and the industry generally. Now, during that period, and even today, it's still very difficult to assess exactly how successful these programs are in onboarding new users, because blockchains are not very good at delineating unique wallet addresses for specific individuals, because we don't have no ability to collect individual data about these customers. So it has long been, suspected that, in fact, the success of DeFi Summer has been massively overstated, because people were creating hundreds, thousands, or tens of thousands of Sybil accounts specifically to qualify for the same, incentive programs many times, and so on. Today, I think a lot of the projects that lived through that period, Bancor included, have moved on from that period in time where we're just trying to incentivize adoption of of a product without a specific business model in mind. So one of the things that I've commented on over the years is that the problem with these kinds of incentives campaigns is that it completely inverts the business model, turning the project into a customer and the people who are using that product as the actual business owners, right? Because you are essentially paying them for their use. And that's the thing that becomes commoditized rather than the use of the protocols themselves for their own sake. And I think that has changed significantly. Although I will say, when times get desperate, when people are going for new funding rounds or whatever, you do see these kinds of incentive campaigns begin to pick up again. So things like, Unichain with their new blockchain, they're obviously incentivizing that very heavily. And every time there's a new protocol that hasn't been around since DeFi Summer, they usually lean pretty hard into incentive campaigns as well. But I will note that the aggressiveness, the hyperbole that we experienced in DeFi Summer was completely detached from reality, where people would routinely report 4 or 5 figure APRs on their product websites in order to attract users, whereas today that kind of abandon for financial realism is much less pronounced. So we're seeing things that are much more moderate and much more reasonable. So it could be that these things are returning to sustainability slowly, but it's still a slow path. I still very frequently see things like 20% APRs just for doing something on someone's product. And remember, a 20% APR is all it took to take down Terra Luna. So yeah, even at 20%, I would still consider these things to be ridiculously high and unsustainable. So in that sense, things are cooling off, but haven't really changed fundamentally. And then after that, AMMs were still a fairly simple device back in 2020. Whereas today we're seeing a much more rich and varied assortment of different models being employed. In 2020, you really just had the Bancor formula, which covers things like Bancor itself, Uniswap, SushiSwap, and everything else. You had things like the M stable perfect constant sum formula, and then somewhere in between, which describe things like curve and things like that. But really, all relatively speaking, the same idea. Stake your tokens here and hope that when you pull them out, they're worth more than what you started with. Whereas today, things are beginning to look a lot more sophisticated. It's no longer the case that users aren't asked to make a decision, and they in fact have to apply some level of skill and planning and risk management to the strategies that they are committing to when they buy a financial service from a decentralized exchange. I think that that's frightening for a lot of people. But I think that in terms of the maturity in the industry, it's actually a much better, even if it has attracted fewer users, it is still a preferred state for us to be in, rather than pretending, right, that not employing something like a risk management strategy or risk mitigation strategy is anything but a recipe for disaster. So things are maturing, I think, is if I had to summarize it. But I think I've spoken for too long, so I'll let Georgi take it from here.
Thank you very much, Mark. Yeah, Georgi, do you have anything to add? What do you think is the theme of DeFi today?
I mean, so back in 2020, DeFi somewhere, like I was really down. Focused on just coding, honestly. So I was barely a user back then, but I did try to, LP, and I did lose. And I did lose some money on like impermanent loss. So I feel like back then as a user, it was really weird. It was hard to figure out, and like Mark said, like you had to have like a risk management strategy, but it wasn't really, no one was really talking about it. So it was like super easy to not make any money if you tried out these protocols. So I was in that boat. I feel like nowadays the scene is way more mature, and the shift that I saw just as a user, it went from, I don't know, like from doing a lot of stuff with AMM. I mean, obviously you always do swaps and stuff, but things are now moved into kind of memes and perps, right? That's kind of the two defining primitives of these times now. I think, and there's like reasons why they came about, but yeah, that's kind of the shift that I'm seeing in terms of what it means for like liquidity models. To be honest, I'm not designing the AMMs and these protocols, so I don't really want to don't really dare to comment too much. But that's definitely the shift that happened. Like we went into a lot more leverage, and in terms of a builder, it went to like a lot more risk and a lot more leverage with these tools. But in terms of the builders, we're getting into a lot more like low latency. All these like chains came about, like MegaETH and Rise and stuff like that, and all the oracles had to start doing low latency and with the perps as well. So kind of on the builder side, that's where things went, and things are still going. And another thing I saw is all these like yield bearing assets that weren't back in 2020. Like now we have, especially all the stable coins, and slightly before that, there was all like the liquid staking, the liquid staking, the liquid risk staking, the restaking, the liquid risk staking. So all these like these yield bearing assets, that was like a big thing that happened. But I feel like the space is very mature now, and you still need a lot of risk management. At least it's easier to find, and it's easier to educate yourself. But there's also a lot more leverage, so you can get hurt.
Yeah, and both of you are talking about the risks that are there for the traders, but the traders are also, well, some of them are very sophisticated, and they might pose some risks for the system, for the LPs, for example. And I was wondering, what's maybe the latest or maybe the most interesting trader behavior you see that's breaking current designs and forcing us to think of new DeFi liquidity models at the moment, or maybe in the past?
Yeah, sure. So I think trader and liquidity provider to me are the same thing. There are takers and makers, right? There are people who who post prices and wait for others to take them, but you're trading if you're a liquidity providing in any capacity. The original AMM motivation was to make sure that there is a way to bootstrap liquidity and keep a market liquid for very long periods of time in the absence of a market maker deciding to do that for you. And I think that was well motivated, and that's really where AMMs became successful. But the criticism that AMMs received, let's say legitimate criticism, was that for people that have a specific trading purpose in mind, the lack of flexibility, right, or the prescriptive model that an AMM represents with respect to the underlying trading strategy that liquidity providers have to subscribe to, is not a very good trading strategy, which is why this idea of impermanent loss feels like it's something that came from AMMs, which of course it hasn't, right? Impermanent loss is something that that happens to us all the time, right? One of my one of the stories that I share with people when we talk about impermanent loss in AMMs is that when I was very young, when I shortly after I was born, my mother bought a house in Sydney's inner suburbs, I think, for something like $30,000, and sold it a few years later for like $65,000, which seems like a really great return. It's like 100% return on investment. But today, that same house is worth something like $6.5 million. So her impermanent loss is approximately $6.5 million. But people don't think about it in those terms, where I think that they actually should, right? Impermanent loss is really just a quantification of seller's remorse. And when you're using an AMM trading algorithm to make decisions for you, then you probably shouldn't be surprised that that compared to either the HODL position or compared to someone who's trading volatility in a more informed way, is probably going to be outperforming you. That's not to say that AMMs are necessarily terrible. They are, they do have sort of a self-mitigating, trading strategy, in the sense that they always reserve some liquidity in case there is a catastrophic change in the value of any of the currencies that that make up its portfolio or something like that. But it still is very, very limiting, and it has a very narrow view of what a trading protocol might look like. Whereas in conventional trading systems, so like centralized exchanges using conventional order books, that is much more flexible, because it gives people the ability to quote specific unit sizes and prices that they wish to trade at. And if you are using things like limit orders on a conventional exchange, you are an LP in the truest sense of the word, right? You are contributing to the way that that market is being made. Now, whether or not you satisfy the criteria of being a market maker according to regulatory definitions or something like that is kind of besides the point. I just mean that you are literally making a market by quoting prices that others can take. Now, that freedom to trade where you want to trade at by quoting prices rather than waiting for others to quote prices is something that was lacking from the DEX landscape for some time, but not because people didn't want it or because people didn't think it was important, but because it's very difficult to implement within the constraints that a blockchain imposes on the applications that are developed on it. So the first attempt at doing this properly was actually, I think, the very first exchange on Ethereum, which was called Ether Delta, which kind of really embodies the challenge really well, because its its gas footprint, its smart contract complexity was prohibitively high, and by if we tried to get that system running today, I don't think it would be able to do very much, just because the congestion levels and overall use of Ethereum proper is just too high, right? And so it's something you can only get away with when gas prices and the price of Ethereum is extremely low. And so as the price of the Ethereum token continues, its upward trajectory, and as the blockchain continues to become more congested, you have to find more pragmatic ways of realizing these kinds of things. So the AMM was really just the first step in that direction. But we're now seeing much more sophisticated products like Carbon from Bancor, which I'm very proud to be continually working on, which allows for arbitrary price quoting. And this is just this is just really the tip of the iceberg. We've seen I think that at least part of the foundation get established by protocols like Uniswap v3, for example, which kind of, even though it was not the first protocol to allow for bounded liquidity provision in sort of the same AMM paradigm represented by the Bancor formula, but certainly it was the most successful. And what's interesting is that even if that model is actually exacerbating impermanent loss, right? Even if Uniswap v3 is actually in general lost more money for users, and that's not Uniswap v3 specific. But in general, concentrated liquidity models are much more risky because they basically remove some of that risk mitigation that's inherent to unconcentrated models. So even if that's more financially damaging to most users, still most users will demand it. And that's partly because I think users don't understand what they're doing, right? The financial instrument that they are buying when they provide liquidity to these kinds of instruments, I think is kind of lost on them. And that's partly a marketing hubris problem and an education problem. But let's not excuse the users themselves. I think they also bear some of the responsibility to self-educate before they learn to use these resources at the same time. But we're seeing that kind of progression continue, not just into things like perpetuals exchanges, as Yogi mentioned just moments ago, but also into more sophisticated abstractions of order books beyond, right, what centralized what has been achieved in centralized venues prior to the advent of blockchain. So yeah, it is changing constantly. Whereas it used to just be one thing and you would only have to understand how one AMM works. We're now at the point where you really need to have like 50 or 60 different AMM designs in your mind all the time to really claim to have any erudition over how DeFi works. So it's it's really blossomed into its own discipline with its own language, its own vocabulary for describing these things. So to say that there is a specific design that we can say is being broken or is being challenged, I think is probably speaking too broad, speaking in too broad a stroke. But I do think that that objective of users being of having more agency, more freedom, and more prescribing their trading strategy to a protocol rather than the other way around is really where the quintessential design paradigm of yesteryear is being broken generally, right, across the DeFi landscape.
Yeah, and would you say that blockchain DeFi protocols sometimes react to traders' behavior and to traders' demands, even with a sort of a time lag because of technological constraints, also because of such things as you said, like gas is too expensive and so on and so forth. So would you say
Yeah.
that? Yeah. Okay. So,
Yeah, of course. I think that unlike unlike developing an Angry Birds game or something for the App Store or something like that, where the turnaround time can be very, very quick, where after users have told you what they like about the game and what they expect in the next game and that kind of thing, you can usually generate those things very quickly and get together an alpha or a beta build and then release the final product in a very reasonable amount of time. With blockchain products, it's not necessarily so, mostly because the amount of engineering that goes into a secure smart contract has a much longer lead time. But then also things like audits take time. Um, the process is just much more involved, so there is always a lag time, and sometimes you also don't really know if you even trust traders when they say that they want to do something. It is often the case that your consumer base is very bad at communicating their expectations, or they use vocabulary that they don't quite understand the meaning of. They're just saying it because they think it sounds good. And they're bag holding for some other project that is using the same vocabulary, and so they're espousing it as being the next paradigm in DeFi or that kind of thing. So there is a lag time. It's I would say mostly due to the complexity of having to realize what that model is going to look like in a way that is compatible with a blockchain deployment, but it's not exclusively because of that. I think there are always these other these other compounding factors that can delay, right, the progression of these things from from good suggestions into actionable plans, and then into finally a well realized smart contract implementation of that idea.
Yeah, thank you so much. Georgi, as a trader, do you feel that you somehow influence the way that DeFi protocols evolve?
Um, I don't know. Maybe just like I mentioned before, everyone's looking for more and more leverage and like more risk, right? So I think that's kind of how everyone is influencing um, these protocols, and just DeFi in general. So I feel like everyone's trying to figure out more ways to add leverage to stuff. And for example, one of the protocols we work with, and it comes out of like earlier I mentioned all these like people on yield, all these yield bearing assets. We went through liquid staking, liquidity staking, stable coins, and then stuff like Panda, Athena, right? And now protocols are like even doing perps on yield, and that's one of the protocols we work with is called Nunchi. They're doing exactly that. So um, we always like whatever new asset comes up, I feel like we want to just level up, and that's kind of one of the main driving things that the users are giving. Or yeah, I mean, I'm yeah, that's kind of my opinion. At least.
Yeah, the next question kind of builds up on the previous one, but I think you've already kind of answered it. But still, do you think that mapbots and other kinds of emerging trading behavior actively shape the protocol design, or they're just exploiting it and the protocols are trying to deal with it basically without um, changing their liquidity models? Or do you actually try to change your liquidity models when you see these new exploitative kind of trading behaviors?
Yeah, I don't think that we necessarily need to categorize solvers, keepers, and MEV bots as being exploitative necessarily. Certainly, there are exploitative MEV tactics like sandwich attacks, hands down, nothing but a nefarious type of arbitrage. But MEV bots generally don't have to be exploitative, and certainly solvers and keepers aren't either. Um, And the short answer to your question is yes. The advent of like the robot trader in blockchains, I think, is becoming incredibly significant. At the moment, we're seeing like retail adoption, human adoption of blockchains is really at an all-time low, and no one's really showing up to use these products. Whereas the bot adoption of blockchains is on the increase, and has long since eclipsed the actual human use case for a blockchain. I had this conversation with the DevRel person at a conference in Belgrade, where we were basically just spitballing the question, like, should we be building products explicitly for bots, right? These are by and large the only customers on a blockchain, right? If you were to remove all of the front ends, right, all of the all of the APY and APR statistics, and all of the stuff that drives humans, and it requires a huge amount of your effort, mostly nothing would change, right? If you somehow evacuated all of the humans from a blockchain, it would mostly look and function exactly the same way it does already. And so I think that is, like, the people who are paying attention from a product level should be taking very special note of that. Not just because it's a trend in the way that the industry is developing, but also because in some ways robots are much better customers than humans are, right? They don't get hacked, they don't complain about things, they understand what they're doing, or at least we can assume that they understand what they're doing. They don't have any predilections about governance or token price or community. They don't care about social media. They just use the product and do nothing else. And they use the product on huge scales, right? Like hundreds of thousands of transactions a day. Whereas, your best human customer might, do like 2 or 3 transactions a day, sometimes, 0 transactions a day. That is absolutely changing. And maybe we shouldn't be so surprised, because if DeFi is art imitating life in a sense, then I wonder if we look across the fence and see what's happening in centralized venues, that we don't really have any excuse to be surprised that over there, 99%, right? 99.9% of all trading activity is also robots, right? Humans really don't have much to do with finance anymore, and they haven't for about 3 decades, maybe longer than that. Maybe in the very beginnings of cryptocurrency and blockchains, that was different. But now, as we bring in more institutional interest, and we're finally getting this institutional adoption that people have been praying for forever, we are going to continually optimize systems that prefer robot adoption, because that is what the people that are actually using blockchains are expecting us to do. So yes, the short version is that I think we're going to see more and more human hostile protocol designs, and the more human hostile it becomes, the more successful I think blockchains will be, just based on on pattern recognition from conventional financial systems.
So would you say that dark AMMs are on top of the system at the moment with regards to this bot use?
So can you repeat that? You broke up for a second.
Yeah, so would you say that dark AMMs or prop AMMs are on top of the system at the moment because they're mainly used by bots?
Yeah, I think, effectively all of DeFi. So AMMs, lending protocols, everything are predominantly being used by bots. But if you have a look at like where the bots are being like the most active, and you've listed them here, I think very concisely: Solver, Keeper, and MEV. But these are 3 sort of mega families that all feed into different different specializations at different parts of the blockchain. starting all the way from the block proposing and validation stages up to naive arbitrage and sandwich attacks and so on. And then up to liquidation and cross-chain arbitrage and things like that. So like there's a very large vertical here that has been annexed by people who build bots for a living, and some of these companies becoming increasingly sophisticated, trying to have their presence realized at every layer inside that vertical. And yeah, they will, if you have a look at the protocols that are catering to that specific interest, they're the ones where the adoption metrics are going well. So yeah, I think it's a foregone conclusion now.
Yeah. Thank you. And since you mentioned arbitrages, so let's talk a bit about risks and dive a bit more into arbitrage and NV math. So, what you said before that you don't think that they are exploitative, and that math doesn't exactly mean like exploitation of the system and leaving LPs with impermanent loss and losing value in the process. So, in AMMs, and later we're also going to compare it with perks. Let's see how arbitrages help prices be aligned with the broader market, but at the same time they leave LPs with impermanent loss oftentimes. And are there models that can balance fairness for traders and profitability for the LPs at the same time?
Yeah, it's a really good question, and I've presented on this topic, in a few different contexts. But I think I spoke about arbitrage and this misconception, right, that it's an extractive process from LPs at ETH Dubai. I think I spoke about it in Serbia and Albania earlier this year as well. But yeah, there has long been this myth that somehow arbitrageurs extract value from liquidity providers. And I think that I'm not sure why, where this came from. At least when you do the mathematics, you can point to a number that says, this is how much value the arbitrageur has made, right? This is their profits. And that profit margin is roughly equivalent to the loss that an LP is likely to experience as they're participating in the market. And so the similarity of those two numbers, I think, was probably mistakenly attributed to being a causal relationship, but it's not, because you can flip the script and remove all arbitrage assumptions from a system, and you see that liquidity providers lose even more money than if the arbitrageurs weren't there in the first place. So it's not, an arbitrageur is not a liquidity provider's enemy. If anything, it's probably net neutral, slightly positive, because it means that the liquidity providers are closing open positions with greater frequency, which is how you realize a fee in an AMM. So let's discuss this in more detail. I think the correct interpretation of where an arbitrageur's profits come from is from what some people call uninformed order flow, right? So if someone is offering a price on one AMM, and there's another AMM that's got a lower price, then you would expect the taker to route their trade through the lower price first before taking the higher price, because it means that they get more trade value out of that transaction. But this doesn't happen very frequently. Instead, traders are mostly random. Like, they don't seem to care about what prices they get. And the ones who do might be using aggregators like 1inch or Odos or OpenOcean and that kind of thing. But even then, all of the not all of them, but some of these aggregators have changed their business models over time, so that it's no longer about efficient order routing, but more about this kind of complex solver process where people can can expect a certain transaction in terms of execution value, but it no longer is representing like the type of trade routing that we enjoyed in sort of the 2019, 2020, 2021 days. It's a completely different system now. So really, if you want to find a good trade route, traders really have to sort of discover it by themselves now, or trust that one of these aggregators is still delivering it, which is just, like, as I'm saying, becoming a worse and worse assumption over time. But the arbitrageur is reliant on people not being able to do this. And most people are too lazy anyway, right? They'll just go to whatever DEX front end they're most familiar with and just process a trade there. And it's that mistake that gets backrun by the arbitrageur. And you can show that that is necessary and sufficient to result in to result in profits for the arbitrageur. So yeah, the profits are really extracted from people who don't put in the work to find a good price. Now, for the liquidity provider who managed to sell their tokens at a higher price than what the market would have suggested those tokens sell for, sure, maybe they have a right to feel that they made a great trade and now the trade is being reversed. To that, I say, too bad in a way. Like, if you want to trade that way, then don't use an AMM, right? Because the AMM is a very specific trading strategy that you are subscribing to, and it necessarily offers bidding and asking prices at every point within an interval, sometimes across the from 0 to infinity. And so you cannot, on the one hand, buy a financial instrument that is designed and almost guaranteed to perform a certain action when a certain, when the market corners itself into a certain state, and then complain when it executes exactly what it said it would when you bought that instrument. It just doesn't make sense. If you want to keep, the tokens that you effectively trade at a certain price point and not have to get backrun, then you should be investigating other types of trading resources, like the irreversible orders that we have on Carbon, for example. Like, these are the things that drive forward, I think, new decentralized exchange design principles, and these are the ones that we have adopted. But yeah, arbitrageurs are not exploiting liquidity providers. And in my opinion, they're not exploiting traders either, because you have to wait for the trader to make a mistake that they would have made anyway. And then you just basically, mop up the difference in value that they've left in the wake of that bad decision making. So yeah, I don't consider it exploitative. I consider it as, certainly it's opportunistic. And it's not nice, I guess, but it's also not predatory.
Yeah, I think it comes from them trying to kind of game the system, because it's not exactly the rules by which you play. Because you're supposed to trade and not kind of try to benefit from those who are trading.
Well, but that's the only reason anyone trades at all, right? Even the person who is performing a trade in the first place, unless they're buying that token to perform an action with it, they're probably hoping that they're going to be able to sell it to someone else in the future at a higher price. So there's really, like, there's no one without guilt, in these systems. Every single person interacting with it is trying to exploit each other.
Do you think that in perps the situation with arbitrages is the same? And Georgi, what do you think?
What do I think about what's like the how I think about arbitrageurs?
Yeah.
Well, I think so. I don't really have a very technical understanding like Mark here, but I think I do buy into kind of the textbook explanation where they're actually just getting the sorting out the market, like bringing it to equilibrium, like sorting out the like differences in the market, which I feel makes sense to me. And kind of encountering them in the wild, I haven't really been hurt too much. I guess also depends on exactly what you like define as arbitrage. I guess some of these things, some of the things that are considered arbitrage could be, I guess, I don't know, could be considered exploitative, but I don't know. I do buy that it makes sense that they exist and they're like actually critical for the markets to exist, right? So, and also like on just as a as a hobbyist, it's always I feel like everyone has to kind of figure out a trade in one time in their life where they do some kind of arbitrage, whether it's like some stable coin deep pegging or and they're like taking I don't know. They have to. It's pretty like it's kind of a fun experience as a guy or just as anyone really. Like if you find an arbitrage in the market and you like take advantage of it and you like fix the market. So yeah, that's kind of my feelings on the topic.
Right. And now I'd like to move to the role that the oracles play in the whole ecosystem. Uh, we've explored how DeFi connects traders and how they affect each other. And then now I'd like to ask, how do you see the oracles going beyond just price feeds now that they are moving towards a new, more modular, more chainlink compatible version? What do you think basically is the future for oracles and their place in the DeFi ecosystem?
Yeah.
Yeah, please go first. Yeah.
No, you go ahead. I think I spoke too much already. You go right ahead.
Yeah, sure. I mean, I can tell you practically what I'm seeing right now, and this kind of the bet that we made also a couple of years ago when we were starting up. It's all these real world RWAs, right? Like all the stocks are coming on chain, different commodities, all kinds of like private equity and stuff like this. Everyone is trying to tokenize. So the like the new age oracles that are more programmable and they can they can cover these assets, right? It still comes down to some kind of financial feed, but that's one thing that's already happening. The other thing that's interesting, I think, is all the programmability allows you to input to bring a lot of risk inputs. For example, you can look for information whether like assets are depegged, whether like an asset is slashed, and just like build out different like risk models and use the oracle, like run them through the oracle and bring those stuff on chain. That's another direction that I'm seeing. So basically, being like knee deep into it, these are two main, and also I think another. This is maybe not so connected to DeFi anymore, but um, all the all the AI stuff like inference calls, having them verifiable. That's also something that oracles are going to be bringing more of, but maybe not so DeFi related. But anyway, on the DeFi side is those two things, like the RWAs. Yeah.
Yeah, I mean the oracles are If we just have a look at like what does it mean to be an oracle, all it means is to introduce data into the blockchain that the blockchain doesn't have available within itself, right? So, we often refer to, the price on a Uniswap pool, for example, as being sort of an oracle price. It's not really an oracle because the blockchain has that, that's more of like just a memory. That's just a lookup, right? Assuming it's on the same blockchain. With respect to the types of smart contracts that we've seen delivered since the genesis of smart contract enabled blockchains, almost everything that has implemented an Oracle system has been DeFi related. So we've seen predominantly price feeds because these are the things that financial systems kind of need to know about, especially if those specific price feeds are more robust or more reliable or more difficult to manipulate when you're pulling the prices from an off-chain source than an on-chain source. And so we've seen things like liquidity pool manipulations in order to drive liquidations and that kind of thing. Especially you were speaking about perpetual exchanges before, right? That's a very common tactic there. And so that's really why price feeds have been like the only thing that anyone can really name or speak about with any confidence when it comes to Oracle implementations up until now. There probably will be, new use cases for this. So, for example, I think whether or not if there is a smart contract that is supposed to be like a mirror image, a proxy for a real world contract, and I think this is what Yogi was referring to when he was speaking about real world assets, maybe not just the prices of those real world assets, but verification that there is, a signed certificate of delivery or something like that, or that the person who is warehousing them is in fact qualified to warehouse them, that kind of thing. That's all stuff that really, could exist on a blockchain, but probably won't for a very long period of time. And so what you will need is some data provider who is able to, to verify that those kinds of certificates and agreements or whatever exist. And then you have to query that database, that off-chain database, with something, right? By pushing that data onto the chain. So I do expect that those are the price adjacent Oracle implementations that we will see if we haven't already. And I agree with what Yogi said. It's going to be primarily driven by the RWA markets.
I'll just say one more thing. It's definitely, it's a lot of RWA happening. I think, and price fees are still kind of the main driver. But one really cool stuff is around like the prediction markets, actually, and especially around like just real world events. Whether it's like a war or recently there was like, I don't know if you guys know this guy called Lord Miles. He's a British guy that went to like Afghanistan before. He was like caught by the Taliban. He was streaming from there, and now recently he went to like Saudi Arabia, and he had a prediction market open for him whether he's gonna do this fast for like 30 days in the desert. And I think, I don't know what happened, but apparently he got caught by the Saudi police, and then I don't know if he's dead or not, but like people, like the market closed, and it closed that he's basically like he was announced dead, and it's like all these weird stuff. So this is kind of an Oracle implementation area where it's getting really interesting, because we have to have like a reliable way to resolve all these like really weird markets, and they can get really weird, right? So and I think that's kind of a cool thing with the ZK sharing coin that we're using, that it could it's basically kind of the UMA implementation, but solving some of the major issues with it, like the bribery, basically the bribery that you can do on the with UMA. So that's kind of I think a cool area where like Oracles are innovating, and it's gonna get a lot more traction now with prediction markets getting big. and they have like these problems, some of these Oracle problems that haven't really been implemented, figured out yet. They'll have to be figured out.
Yeah, and you've anticipated a couple of my questions about the ZK stablecoin and how it's going to transform the way you feed data and how you're going to approach these RWAs. But yeah, I'm also wondering about ZK proofs and oracles. How might this kind of verifiable data change liquidity models themselves? Do you think that it's going to affect DeFi protocols in any way?
I don't think it's
please.
going to. Yeah, I don't think it's going to change it too fundamentally. I think yes, like the specifics of the implementation might change, right? But the actual product that it represents, the abstraction, doesn't really care about how the oracle works, only that there is one. Or even then, like sometimes whether or not an oracle exists or doesn't is still irrelevant for the abstraction of what that financial instrument is. So I don't think that it will change the liquidity model too much, but at the with respect to how the protocols are engineered, it might change.
I mean, again, I'm not designing the protocols, but I'll just say practically what I'm seeing is there's like a lot of ZK powered like proof of reserves and like proof of the NAV. So for like these, especially for the RWA assets. So this is kind of where the ZK right now is being used. Like that's one of the major use cases, proof of reserve. So I think that's kind of having an effect. I'm not sure. Yeah, I don't know how to describe it within like the parameter of the question, but practically that's what I'm saying.
Yeah, I'm thinking that ZK proofs might also improve speed, and I was wondering if maybe like this real-time data might help with risk management and maybe liquidations.
It certainly will. Time latency is an extremely important factor when it comes to risk mitigation. I don't think that it's necessarily going to be life-changing for anyone who's already using these protocols, but there will be there will be sophisticated players who will be more interested, I think, in using them if they can mitigate their risk more effectively. So yeah, as the latency improves, then you start to attract those like upper echelons of sophisticated players. But for the people that are already using the protocols today, I doubt that the significant time improvements would have much of an impact on their specific trading strategies.
All right, and the last question. If you look a couple of years ahead, what do you think will define the next phase of DeFi, and what role will oracles also play in it?
Go
What
ahead,
do you think,
Yogesh. You've
Mark?
got a okay.
I mean,
Yes.
for me, it's like earlier I mentioned, everything going lower and lower latency. So if everything will go into live, and then there will need to be like live resolutions of stuff. Let's say watching streams, and I'm gonna be like opening like bets that I prediction markets on how many like kills the guy is gonna get in the game, or maybe even like if he's gonna do some kind of prank in the real world, and these things will need to be resolved like live. And I think that would be kind of like the big thing for oracles, like ultra low latency live resolutions of everything.
Yeah, so for me, I think looking 2 to 3 years into the future, I think that what we will start seeing is more. Well, I mean, we've already started to see it. I expect the trend where the institutional adoption of blockchains continues, but it doesn't look anything like what the early adopters of blockchain thought it would look like. Because I think that you know, I was there in 2019, 2020, 2021 for the kind of, you know, hopeful wish thinking that, you know, imagine when BlackRock and such, you know, joins us in DeFi, and they're going to be providing liquidity with us on Uniswap, right? And they're going to be committing capital to Compound and liquidity mining with us and this kind of thing. And that's not at all what it's looking like. Sure, like some of these institutions are showing up, but the first thing that they do is start looking at ways to implement their own version of these protocols and then exclude people that they don't want to trade with from using them. Usually because they have, you know, a very specific list of clients that that between them they have an understanding that maybe blockchain is going to service that specific need. And if, you know, and if they don't have that specific need serviced by blockchain, they'll figure out some other way to do it. But that is, like, to my mind, the most compelling, you know, I don't want to call it a narrative, but it's the most compelling shift, I think, in the understanding of how blockchain is being adapted by civilization, right? Where we're kind of moving out of that experimental phase where no one really knew what blockchain and DeFi would look like at scale, right? When it was still just a bunch of weirdos from 4chan, you know, throwing imaginary money around on this new paradigm. But yeah, I consider that, I think that this will be the way that things continue to progress. And oracles will service exactly the same use in that paradigm as they have in the old one. It will just be, you know, the same oracle implementations being used in more specific in more specific cases.
Thank you. Thank you so much. And yeah, I'd like to thank you both for joining this call and contributing so wonderfully to this panel. I really appreciate it. And if you're viewers, if you're building a DeFi, follow Carbon DeFi and Bancor for next-gen liquidity design, and Blocksense for ZK-proof advances in data feeds. And I'd like to finish with with Mark's quote from today that I loved, which is that impermanent loss is a quantification of seller's remorse. Thank you so much for this quote, and thank you for joining us. Bye.
Thank you so much for hosting us, Julia.
All right, thank you. Bye bye. Have a good one, guys.